Hello, options traders. Well, I have a great question for everyone. What is an adjusted option? And that was a question that was posed to me on Friday by one of the traders in our group here talking about Salesforce CRM and looking at some strange expiration dates. And he's going, how come there's two different expiration dates for the same contract? And so that will always happen whenever you see an adjusted option. However, if you don't know about them, they can create an easy trap to step into. So let's take a look at adjusted options. First of all, understand that there are many types of corporate actions, things like stock splits, mergers, acquisitions. And whenever they happen, the option contracts are adjusted in some way to keep the terms fair to the buyer and the seller. There's no funny business going on. People think that it's done to rip people off and whatever. It's not. It's to make the contracts fair. So as a simple example, let's say that you have one $100 call and the stock goes through a 2-for-1 split. Well, if they didn't make any type of adjustment to this call, the next day that stock's going to be trading at half its value at $50. And the shareholders would receive twice as many shares. But you, on the other hand, would be sitting here with your $100 call that's now 50 points out of the money and it goes up in smoke. Well, that's hardly fair. So what happens? The contract gets adjusted. And you would find that automatically in your account, you would find two $50 calls the next day. The key to notice is that the adjustments are always done to keep the exercise values the same. So in this example, if you exercised one $100 call, it would cost you $10,000. And if you exercised two $50 calls, it would also cost you $10,000. The exercise values are the same. Nothing is gained and nothing is lost, and that's why the adjustments are done. Let's go over to the E-Trade platform and take a look at the expirations that he was talking about. So here we are on Salesforce, ticker CRM. And if you look across the various expiration dates over here, now these in these kind of this purple color are the weeklies and extended weeklies. In gray is a standard monthly contract. But look over here. Suddenly I've got a January 19, and then right next to it another January 19 in gold. I keep going out here to the right, no more duplicates until we come up here. I've got a Jan 20 and then another Jan 20 in gold. What's going on here? How come I have duplicates? Well, this is the first sign that it's an adjusted option. Most of your platforms will highlight it in a different color or flag it in some way, but if they don't, if you happen to see two expiration dates that are the same, one of them is adjusted. So how can you figure it out? Well, there's a few ways. Let's come back here to the Jan 19. And if you look below, it says that the deliverable is $3,614.11 in cash plus 7 shares of CRM. But if I come to this Jan 19, it just shows 90 days to expiration. And that tells you this is a standard contract. There is no adjustment to this one. And that will always be true. Whenever a particular expiration month is adjusted, they will at the same time create a brand new one that is non-adjusted. It will be the standard contract. So if you're looking to open a position, always take the non-adjusted one. So if you were trying to buy calls, let's say, for January 19 for Salesforce, you should be using this expiration, not this one in gold. So what caused this? Well, how come we're seeing that there's $3,600 in cash and 7 shares of CRM? Some type of a corporate action happened. So if you get this, let me show you a way that you can find out what happened. All you have to do is go to your browser and type in theocc.com. That's the Options Clearing Corporation. This is the group that's in charge of settling option contracts. And down here it says Information Memos. And you could either scroll through it here and find it, or more simply, just come up here to the search box and type in CRM. I've already got it typed there. Let's click it, choose our magnifying glass, and you'll see various memos. So right up here at the top, click there. And here is OCC Memo 43-124. And it shows that on May 25th, MuleSoft, different company, was acquired by Salesforce. And it was done so at $36 per share. So that's where the $3,600 of cash is coming from. However, there were also 7.11 shares of Salesforce included in the deal. But because you can't get 0.11 shares, what they did is they just gave that to the traders in cash. So they're showing here the 0.11 times the Salesforce price at the time, $128.29, gives you an additional $14.11. So in total, that's where the $36.14 is coming from. $3,600 cash, again, that was the deal price, $36 per share, plus $14.11. But then you also get the 7 shares of Salesforce. So that is the new deliverable per contract right there. Also notice down here, the multiplier stays at 100. That will not always be true. Sometimes it will change. They try not to change that, but sometimes it does get changed. And what that means is that when you're looking at the option quotes, you would still multiply that premium by 100, as you normally would. So if the option is trading for 3, you know that that really means 300. But again, if this was 150 and it was trading for 3, it would really cost you 450. So sometimes that multiplier will change. So it's a very nice way to figure out exactly what happened, when it happened, and what the adjustments were. So let's go back into the E-Trade platform. Here's our adjusted January 19. So now it's very obvious where the 36.14.11 in cash came from, plus the 7 shares of CRM. But here's another little thing that would have clued you into that this is probably an adjusted option. Notice that the strikes only go from 35 to 55. But when you look at the other Jan 19, they're more into the hundreds, almost up into the 200s, because this is more in line with the current price of Salesforce. If we go back to the adjusted one, not anywhere near close. And that's because this was at one time a MuleSoft option, and MuleSoft was trading more in these ranges. So it was only these strikes that got adjusted. So another question, why do we only have adjustments for January 19 and for January 20? Well, that's because back in May when the announcement was made, these were the only 2 contracts that were on the board. The others were not there yet, and they have since been listed. So that's why these are the only ones that got adjusted. So another question that traders have is there some free money we can make here, since this contract now holds this big basket of cash? Not at all. Remember, the markets understand that cash is in there, and they're just going to simply price it into the contract. So for example, let's take a look at this 35 strike right here. And if we look at the mark, that's the midpoint between the bid and the ask, trading for about $11. If we paid $11 for this contract, and then we exercised it and paid an additional $35, we have paid a total of $46, or roughly $4,600. What would we get in return? We would get $3,614.11 in cash and 7 shares of CRM. What's that worth? Well, 7 shares at 140.49 is $983.43. So when we add that to the $3,614 cash, we're getting almost $4,600. $45.97 and change. So you can see there's really not much value in there. There's really no extrinsic value. And that's why this column right here showing blanks. So this is another trap that often catches new investors. Many people might use, let's say, a covered call strategy, and they find an adjusted option that might have a boatload of cash in it, and they mistake that for being extrinsic value. So the option might be trading for a very large price, but that doesn't mean that there's any extrinsic value in it. So what's the moral from all of this? What do you really want to take away from this? Understand that whenever you have an adjusted option, generally speaking, they should only be used to close existing positions. The reason those contracts were created, these adjusted ones, is to keep the terms of the deal fair for the people who had the contracts prior to the announcement. So if you had a MuleSoft option, it gets acquired by Salesforce, at least you have a way to close the contract at a fair value. However, you do not want to open a brand new position in this. You shouldn't be buying to open or selling to open. Why? Because they're weird contracts. Who wants to trade a contract that controls 7 shares of Salesforce and $3,600 in cash? So what happens is that these contracts become fairly illiquid. Second, you can end up with wide bid-ask spreads, and that's because they're illiquid. Not a lot of people trading them. If we come back into the E-Trade platform, let's take a look at these Jan 19s. The 35 strike. Look at the bid, $855 offered at $1350. The 40 strike, $355 to $850. Very wide bid-ask spreads. So again, if you're in this position prior to the announcement, this is the contract you need to close. Why? Because your contract controls $3,614 in cash and 7 shares of CRM. You would not want to close it against this contract. That controls 100 shares of Salesforce. Completely different contract. But you don't want to open a position in this because you're just going to end up with these wide bid-ask spreads and a very illiquid contract. So if the only thing you understand from this is that to keep your eyes open for an adjusted option and don't open a position in that, and that will help to keep you out of a lot of trouble. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.